Hudson's Bay is closing up shop, but that doesn't mean you'll see its brand or logo disappear anytime soon. Canadian Tire is spending $30 million to acquire the intellectual property of Hudson's Bay. It's not a massive move by any stretch, but it could be a key one for Canadian Tire that could pay off in the long run. In this video, I'm going to go over what it may mean for the business and why it could make the stock a better buy in the long run. It's important to note that Canadian Tire is not acquiring the physical stores themselves, but instead the trademarks, brands, including its well-known coat of arms and multicolored stripes, which HBC is known for. The deal may close as early as this summer, and here's what I like about it. The brand is a popular one in Canada, and it's known for premium priced products, something that isn't exactly synonymous with Canadian Tire's more blue-collar brands. It's a huge opportunity for the company to expand into higher-priced clothing and goods, including housewares. That can mean more room for expansion throughout the country. Canadian Tire already has over 1,400 retail locations and may have been looking a bit saturated up to this point. Plus, expansion into new products and clothing line present further opportunities. By doing this deal, not only can that add to the company's top line, but also potentially improve its margins, since HBC is known for those premium priced products. For a fairly modest purchase price of $30 million, it provides Canadian Tire with an easy way to expand its growth potential. And that's important for the business as its growth rate has been volatile in recent years, often in the single digits or worse. And with tariffs creating a new risk for retailers in Canada, it's never been more important for them to diversify than now. The company already has some popular brands in its portfolio, including Mark's and Party City, which it acquired back in 2019. Canadian Tire now continues to grow its portfolio of strong and iconic consumer brands in Canada. The company generated $848 million in profit over the past 4 quarters, and it's in a good position to be able to take on this deal without it affecting its bottom line. Its annual revenue has typically been around 16 to 17 billion in recent years, and by leveraging HBC's brands, that may be what it needs to jumpstart its growth. Canadian Tire stock currently trades at 11 times its trailing earnings, which isn't terribly expensive given how vast its operations have become. This year, the stock has been doing fairly well, rising by close to 11%. And on top of the stability and growth potential it possesses, it also pays a fairly high dividend, which yields 4.2% right now. Overall, I think the HBC deal is a good one for Canadian Tire, as it can unlock some potentially attractive opportunities for the business down the road. And so whether you want dividends or a solid Canadian stock to own, Canadian Tire is a great option to consider for your portfolio, especially inside of a TFSA where you can just allow it to grow in value over the long haul. So what do you think of this news for Canadian Tire? Is it a good move, or do you think it'll have minimal impact? Let me know in the comments. And if you enjoyed this video, please make sure to leave a like and subscribe for more. Thanks for watching.